Welcome to Investors Insights. Our topic today, shutdowns and stress. We're hearing from a lot of clients frustrated. Maybe they're having issues with their cable. Maybe they're having issues with a writer's strike. Maybe they're having issues with the possibility of a government shutdown. All these type of situations are causing stress, and we wanted to address that today in our vlog. I had a phenomenal meeting today with my colleagues, Trey Booth, Bobby Norman, and Ty Miller. And in there, we were talking about the dynamics in this economy, the changing business models, technology advancement, and also the stress that's being caused by the strikes and shutdowns that we're starting to see. And so with that, Bobby, man, you did a great job. I really appreciate the way you addressed the data on shutdowns. Can you relay that to our viewers this morning?
Yeah, so we're watching news out of D.C. this week for what is expected to be a few weeks of tough negotiations to try and avoid a government shutdown by October 1st. So negotiations are set to begin this week when both chambers of Congress are set to be in session for the first time since July. And so there's no doubt that investors will be watching negotiations closely for potential impacts on the market. So what we've done is we've taken a look back in history to see what impact previous government shutdowns have on the markets. And really, history says the market takes government shutdowns in stride. And so look at this first chart here. It covers the past 20 government shutdowns since 1976 and the impact of the markets. We actually found that the market was almost exactly flat after adding all the stoppages together. And so while government shutdowns cause initial volatility, the market action has been more dependent on other factors like corporate earnings. Looking at the second chart that shows specific performance of certain government shutdowns that lasted longer, you can see that the market performance hasn't been impacted as much as investors might think, and that even in the 2018-2019 standoff, the longest in U.S. history, you can see there on the chart, the S&P rose almost 8%. So as always, we analyze historical market performance in preparing for events like government shutdowns that will no doubt be a hot topic over the next 2 weeks. So no guarantees, and every event is different, but history says the market takes shutdowns in stride.
That's good. I thought that chart was excellent in the way you broke that down. And then, Trey, in our debates and discussions this morning, you really talked about, with the government being shut down, the data collection to kind of, with the Fed meeting and, decisions coming up here. They need data to make their decisions about interest rates and other decisions. So tie that in with what Bobby just shared with us.
Yeah, thanks, Greg. The Federal Reserve will meet this week and make their announcement about current rate policy. Now, the market fully expects no action, and what that is, that's keeping the Fed funds rate with a high-end level of 5.5%. The next meeting will be at the end of October, early November, November 1st. And the Fed has spoken a lot about how they are going to be very data dependent in their decisions. And we're really at an important inflection point right now where we've seen inflation bottom in July, and it has gone up the last two inflation reports, the most recent one we got last week. And so where it goes from here, is this just an anomaly caused by potential increases in oil, or is this a trend that the Fed needs to keep an eye on? And this is happening at a time when the data may stop, what you alluded to. A lot of times when the government shuts down, most people don't really notice. The reason why the market isn't very impacted, most people don't really notice that shutdown in their day-to-day lives. Most people probably, besides us, don't notice that government reports of data like inflation and jobs don't come out during a shutdown. This time may be different, though, with the Fed noticing very much so the government shutdown, if that important CPI report in mid-October or the jobs data in early October does not come out. What data will the Federal Reserve be relying on to make their very important, what we feel like, November decision? So something the Fed's going to have to watch closely. And why is this such an important pivot point is because we've mentioned this before on a vlog, but our research partners at Strategas looked over 2,000 years of economic history. And in those 2,000 years across 24 countries, they found 62 instances of higher prices or inflation. And of those 62 instances, only 8 saw prices go up and then come back down and stay down. Every other instance, they saw prices go up, come down, and then go back up again for at least a second, maybe even a third wave. And so the Federal Reserve very much wants to keep an eye on that because they do not want that second wave to come. We saw prices come down. We've seen a tiny hitch up does that hitch continue? And are we in fact looking at a second wave? That's something the Federal Reserve very much wants to keep from happening. And if they don't have the data to support that, what are they going to be relying their decision on? Something we're going to watch closely, and the markets are going to start watching very closely as we get close, not just the next Fed meeting, but those traditional data releases.
No, I thought that was great insight. Nobody wants to repeat the 1970s as well as other years that you've got in your research with Strategas. And so we'll be watching that very closely as the weeks continue here and the whole government shutdown. And with that, Ty, you also just talked about consumer stress. I need to say this. I am constantly amazed the advancement with technology and data collection and all the information that we can gather here at File Plan Partners. But I thought this one in particular was interesting in relation to what Trey and Bobby were talking about, consumer stress, and that there are parts of the country that have higher stress levels than others. And you opened my eyes to some data today that I thought was excellent. So talk about that.
Yeah, so our research partner, Strategas, runs kind of a proprietary indicator called the Consumer Stress Indicator. It measures food at home, mortgage rates, and gasoline prices, and they kind of lump them all together and get a number. And so for this cycle, we peaked at 24% on the Consumer Stress Indicator, which is really high. It's come down pretty steadily down to 14% here. We're starting to maybe moderate that decline. 14% is still about 40% higher than the indicator average of.
That's what you were saying,
roughly, throughout the 2010s. And so right now we're at 14%, which is good. Do we continue to, kind of moderate back down to that 8% number, or do we kind of flatten out? And that'll be interesting to see. We have a lot of, I don't want to say a lot, but we have some headwinds here that the consumer is facing. Gasoline prices are now positive year over year for the first time in 7 months. I know that, gasoline prices at the beginning of the year really showed some strong improvement for people. And now that they're coming back up, it's going to be interesting to see. Trey mentioned the inflation number. Bobby mentioned the government shutdown. I have a chart here about United States strikes. The amount of workers on strike have really gone up. And this is only through August. This doesn't even include the other 13,000 or so people that went on strike just last week for the UAW auto workers. We have a lot of factors here. And then one interesting statistic that kind of lumps in with that consumer stress indicator is this chart here that shows by city the U.S. consumer pain. And Miami has consistently been at the top. Detroit just overtook them at 10.7% here. And it's going to be interesting to see what happens going forward with the new strike.
Well, and speaking of Detroit, United Auto Workers, there's kind of a tie in there, correct?
Yeah, absolutely. That very strong tie there. Detroit, of course, Motor City, and so it'll be interesting that the consumer has really done well to been one of the catalysts to avoid recession this year. Consumer's been very resilient, and it's going to be interesting to see if that resilience is tested here with a lot of factors going against it for the back half of the year here.
Yeah, no, I thoroughly enjoyed it. It was a great meeting, and I really want to emphasize the amount of time and research these guys do on our portfolio strategy side. Also, they're referencing Strategas as one of our research partners, and we subscribe here to a lot of outside research and constantly debating, brainstorming, and trying to look ahead as to where the markets and economy may go and the trends that we spot that tie in together with each other. We also continue to have these discussions on Facebook, Twitter, LinkedIn, our podcast, on YouTube. We're going to continue to expand those as well because we've gotten such great feedback. We appreciate the way you're sharing our blog with others who may be under stress right now because of what's going on in the economy or with their careers or in their family situations. We strongly believe in your financial house and the financial blueprint tied to portfolio performance here at File Plan Partners, and several of you shared my book as well. We thank you so much. We thank you for believing in us. We hope you have a great week, and we're going to move forward and keep you updated after the Fed meets. Take care.